And one thing, Anand, that I know you've been involved with is family investment companies. So particularly where a company is going to cease trading, but it has substantial amount of cash in that or investments in that business. Can you just run through how they work and what are the benefits of having one?
Yeah, so as you say, family investment companies have become very popular in the last 10 years. Um, there have been variations on it prior to that point, but I think the attraction for the family investment companies has been aligned with the fact that the corporate tax rates had been quite low, at 19% for a number of years. Obviously, the corporation tax rates have gone up now, but there's still attractions there with a family investment company, which essentially what it is a company that is a wealth manager for a family. In very simple terms, a company can invest in what it likes, whether it's property, whether it's stocks and shares, whether it's crypto. It's a vehicle for which money in a company can be you put to those investments and can grow. And the tax aspect to it is often mostly suitable for people who have a pot of money that they don't think they'll need, they won't need to draw on. And effectively, the attraction there is, again, this gross roll up facility where there's money in a company and it's put to investment, and that growth can then pass to next generation. For example, if family investment companies set up properly, and equally, family investment companies can work with trusts. It goes back to what we referred to earlier, that it's quite common to see family investment companies where shares for the next generation are held in trust in order to beef up the asset protection side of things. And the other attraction with family investment companies from a tax point of view is, I say, we most commonly see them invested in a stocks and shares portfolio, and dividends from a portfolio, they would be tax free in general for the company. So again, you're starting to look at, well, what are the benefits of a family investment company? Well, the alternative of not having the company is having it in your personal name. And of course, any income arising in your personal name will be taxed at your marginal rates of tax. Whereas in the company, again, it can grow tax free if it's the right type of investment. Equally, given the changes to landlord taxation, the restriction in mortgage interest that's been staggered in and is now fully in place and has been for the last couple of years, we do see a number of people deciding to start a rental property portfolio, but having a company and not having it in their own names to begin with. Um, Again, there's attractions there, and as well, let's not forget outside of the tax benefits, and we'll talk specifically about property. Limited liability protection, that's quite as well, because actually it gives a shield to the shareholders from the liabilities of the company.
Yeah, absolutely. There are lots and lots of different ways, aren't there? You said originally, right from the beginning of this interview, that you were finding that some were moving abroad. I think you cited UAE as being quite a popular destination. So, are you seeing more vendors or business entrepreneurs moving offshore for a lower tax environment? What are the pros and cons of some vendors thinking, that's what they will do, and perhaps move abroad? I don't know whether it's a permanent or for the next 4 to 5 years. What are the advantages?
I think most people we're talking to, and I think we alluded to it earlier, is actually people growing their businesses. So this isn't necessarily a retirement plan. And I think that's possibly a change that we've seen in the past 10 years, 10, 15 years, that often you would have people retiring abroad. Now, actually, what
Yeah.
you're having is people growing businesses and realizing they don't need to be in the UK to do that. So actually, it won't necessarily be as part of an exit plan. However, if someone's thinking about selling their business, the UK company, um, maybe in the next 5 years, maybe in the next 10 years, the sooner you can establish your non-UK residency from a tax point of view, the better. There basically are anti-avoidance rules, which means that if you're non-resident and you sell your UK business, initially no UK capital gains tax payable, maybe tax payable in the country you live in. And as long as you stay out the UK for 5 years and don't become UK tax resident, then that disposal stays outside of UK tax completely. So, and it's interesting, we've alluded to it a couple of times. Is that something that might change in the budget? Because it's in one way quite a generous tax relief. And you can understand why it was there from a economic growth point of view, because what successive UK governments have seen is we don't want to discourage inward investment. We don't want to discourage foreign investors coming in investing in UK businesses by then slapping them with capital gains tax. But it does in a way seem, as I said, quite generous, that non-UK people, non-UK resident individuals can sell UK assets, UK shares, and not pay a capital gains tax.
Yeah, and the downsides of that is presumably those individuals are very restricted how much they can come back into the UK, isn't it?
Yeah.
So if they have aged parents, for instance, or whatever, it could be a big issue, couldn't it?
Absolutely.
Or they've got their own kids and they want to see their kids, grandkids. There is a potential issue there.
Absolutely, and I think what's been very useful is the introduction of the statutory residence test, which is now over 10 years old. But very briefly prior to that, tax residence wasn't as well defined as it is now since the SRT came in. So what it does mean is, you're quite right, that to become and stay non-resident requires some planning and thinking. The good news is that it is something you can control to an extent, because the way the SRT works is you can look ahead, you can say, I've got these connections to the UK. Once I leave the UK, I've got these connections to the UK, and therefore that will dictate how many days I can spend in the UK but still be non-UK resident. So, you're quite right. Again, there can potentially be a misunderstanding. What is, UK tax residency? And it doesn't mean you can spend 0 days in the UK. You can spend some days in the UK, and as you say, for personal reasons, that's going to be an option that people will generally take up. Elderly parents is one that we've dealt with in the past year or so. But equally, as I said, because of the profile of individual we're getting the questions from, sometimes we do have people who will say, the main earner will move abroad, but the family and kids will stay in the UK, for example. We do see that sometimes as well. And again, that main earner can spend some time in the UK. They just have to manage it properly. And obviously, as you will have thought, the right tax advice is vital in that case, because what you don't want to do is trip over into having earnings taxed in the UK that don't need to be.